Question 1. Scenario-based. Mr. Smith, age 65, is reviewing long-term care insurance options. He is in good health but is concerned about future potential cognitive impairments. He wants coverage that will allow him to receive care at home if needed. One of his key priorities is ensuring that his premiums won't increase unexpectedly, but he is also considering adding an inflation protection rider. What should Mr. Smith consider when evaluating his long-term care insurance options? Mr. Smith should prioritize selecting a policy with guaranteed renewability and compound inflation protection to keep his coverage current with rising care costs. B. Mr. Smith should focus solely on choosing a policy with the lowest premium, as this will guarantee affordability in the future. C. Mr. Smith should avoid adding inflation protection since it increases his premium significantly and focus on policies with elimination periods instead. D. Mr. Smith should prioritize finding a policy that covers only nursing home care, since that's the most expensive form of care. Answer: A. Mr. Smith should prioritize selecting a policy with guaranteed renewability and compound inflation protection to keep his coverage current with rising care costs. Explanation: in Arizona, guaranteed renewability ensures that Mr. Smith's policy cannot be cancelled by the insurer as long as he pays his premiums, providing long-term stability. Compound inflation protection adjusts the benefit amount to keep up with inflation, which is critical as healthcare costs increase over time. Arizona law mandates insurers to offer this option, though it increases the premium. Choosing the lowest premium, option B, without inflation protection may seem economical initially, but it can result in insufficient coverage as care costs rise. Avoiding inflation protection, option C, exposes Mr. Smith to potential underinsurance, limiting coverage to just nursing home care. Option D ignores the flexibility of receiving care at home, which Mr. Smith prefers. Question 2. Eligibility for benefits. Which of the following triggers must typically occur for a long-term care insurance policy to begin paying benefits in Arizona? A. The policyholder has difficulty performing at least 2 activities of daily living, adults, such as bathing or dressing, or they suffer from severe cognitive impairment. B. The policyholder is admitted to a hospital for an unrelated medical condition and stays for more than 3 days. C. The policyholder is under 65 years old and experiences any illness, regardless of its severity or impact on daily activities. D. The policyholder is diagnosed with a minor, temporary injury, such as a sprain, requiring home rest for 2 weeks. Answer: A. The policyholder has difficulty performing at least 2 activities of daily living, adults, such as bathing or dressing, or they suffer from severe cognitive impairment. Explanation: in Arizona, most long-term care insurance policies require the insured to have a functional deficit in at least 2 adults or a diagnosis of severe cognitive impairment, e.g., Alzheimer's or dementia, to trigger benefit payments. This is in line with federal and state laws governing qualified LTCI policies, ensuring that benefits are paid for conditions that significantly impair daily functioning. Hospitalization, option B, is irrelevant unless it directly affects the DLS or cognition. Age alone, option C, or minor injuries, option D, are not sufficient to trigger benefits under standard long-term care insurance policies, as the purpose of LTCI is to cover long-term, chronic care needs rather than temporary or mild conditions. Question 3. Policy provisions. What is the primary purpose of the elimination period in a long-term care insurance policy? A. To establish a time frame in which the insured can cancel the policy without penalty after purchase. B. To define the period during which no benefits are payable after a qualifying event, requiring the insured to cover care costs out of pocket. C. To lock in the premium rates so they cannot be increased by the insurer. D. To ensure that the policyholder receives immediate benefits from the policy after meeting the benefit trigger. Answer: B. To define the period during which no benefits are payable after a qualifying event, requiring the insured to cover care costs out of pocket. Explanation: the elimination period, also known as the waiting period, is a common provision in long-term care insurance policies. It specifies the number of days the insured must pay for their own care before the policy begins to cover expenses. This period typically ranges from 30 to 90 days and serves as a deductible in time, reducing the insurer's short-term liabilities. Arizona law requires insurers to clearly disclose elimination periods in their policy documents. Option A confuses this with the free look period, during which a consumer can cancel the policy shortly after purchase. Option C refers to rate stability, which is unrelated to the elimination period, and option D misrepresents the elimination period's function as it delays rather than accelerates benefits. Question 4. Coverage and benefits. Which of the following services is not typically covered under a standard long-term care insurance policy? A. Skilled nursing care provided in a nursing home or skilled care facility. B. Custodial care provided in an assisted living facility for help with daily activities. C. Home health care provided by licensed professionals in the insured's residence. D. Cosmetic surgery to improve appearance following an accident or illness. Answer: D. Cosmetic surgery to improve appearance following an accident or illness. Explanation: long-term care insurance policies typically cover services such as skilled nursing care, custodial care, and home health care. Options A, B, and C, as these are essential services related to daily living and medical care. Cosmetic surgery, option D, is considered an elective procedure and is not generally covered under LTCI policies because it does not relate to functional impairment or the insured's ability to perform activities of daily living adults. Arizona regulations ensure coverage focuses on medically necessary services, particularly those required for chronic conditions or impairments. Question 5. Arizona-specific regulations. In Arizona, what is the minimum free look period for long-term care insurance policies during which a policyholder can cancel the policy for a full refund? A. 10 days. B. 15 days. C. 30 days. D. 60 days. Answer: C. 30 days. Explanation: Arizona law mandates a 30-day free look period for long-term care insurance policies. During this time, the policyholder can review the terms and conditions and cancel the policy for a full refund if they are unsatisfied. This provision is designed to protect consumers, ensuring they have adequate time to make an informed decision. Shorter periods options and B do not meet the state's minimum requirement, while 60 days option D would exceed the legal mandate but is uncommon in the industry. Question 6. Policy features. Which policy feature allows the insured to stop paying premiums while still receiving benefits once they qualify for long-term care? A. Inflation protection. B. Non-forfeiture benefit. C. Waiver of premium. D. Guaranteed renewability. Answer: C. Waiver of premium. Explanation: a waiver of premium feature allows the policyholder to stop paying premiums once they qualify for long-term care benefits without losing coverage. This ensures that the insured will not be financially burdened with premium payments when they are already facing the costs of long-term care. Inflation protection, option A, adjusts benefit amounts to account for rising care costs, while non-forfeiture benefits, option B, preserves some level of coverage even if the policy lapses. Guaranteed renewability, option D, ensures that the policy cannot be cancelled as long as premiums are paid, but it does not affect premium payment requirements during the claim period. Question 7. Cost of long-term care insurance. What factor primarily influences the initial premium cost of a long-term care insurance policy? A. The age and health of the insured at the time of application. B. The insured's medical history after the policy is purchased. C. The insured's income and financial assets. D. The number of years the insured has owned the policy. Answer: A. The age and health of the insured at the time of application. Explanation: the initial premium of a long-term care insurance policy is primarily determined by the applicant's age and health at the time of application. The younger and healthier the applicant, the lower the premium because they are less likely to need care in the near future. Once the policy is in place, the insured's medical history, option B, and the number of years they have owned the policy, option D, do not influence the premium. An individual's income and financial assets, option C, are not used to calculate premiums but may be considered when evaluating the suitability of the policy. Question 8. Medicaid and long-term care. How does Arizona's long-term care system ALCS program affect Medicaid eligibility for long-term care services? A. ALTCS allows Medicaid to pay for long-term care services without requiring a spend-down of assets. B. ALTCS requires applicants to spend down their assets below certain limits to qualify for Medicaid. C. ALTCS automatically provides long-term care benefits to anyone over the age of 65. D. ALTCS only covers home care and does not cover nursing home or facility-based care. Answer: B. ALTCS requires applicants to spend down their assets below certain limits to qualify for Medicaid. Explanation: under Arizona's long-term care system, ALCS individuals must spend down their assets below a certain threshold to qualify for Medicaid-funded long-term care services. This ensures that only those with limited resources are eligible for state assistance. Option A is incorrect because Medicaid typically requires a spend down to meet eligibility criteria. ALTCS does not automatically cover individuals over 65. Option C, without financial and medical eligibility criteria, and it covers a range of services including both home care and nursing home care. Option D. Question 9. Suitability of LTCI recommendations. When recommending a long-term care insurance policy in Arizona, what is a critical factor an agent must consider to determine whether the policy is suitable for the client? A. The client's ability to pay premiums without relying on their assets. B. The client's expected life expectancy of at least 15 more years. C. The availability of an LTCI policy from multiple competing insurers. D. The possibility that the client may move out of state within 5 years. Answer: A. The client's ability to pay premiums without relying on their assets. Explanation: Arizona law requires agents to ensure their recommended long-term care insurance policy is suitable for the client's financial situation. This includes confirming that the client can afford the premiums without depleting their savings or other assets. Long-term care insurance is a significant financial commitment, and an agent must assess the client's ability to sustain premium payments. Factors such as life expectancy, option B, competition between insurers, option C, or future relocation, option D, are not primary considerations in determining suitability. Question 10. Ethical sales practices. Which of the following would be considered an unethical sales practice under Arizona law when selling long-term care insurance? A. Recommending a policy that includes inflation protection to an individual in their 50s. B. Offering a replacement policy without disclosing potential loss of benefits or increased costs. C. Advising a client to add a waiver of premium rider for long-term security. D. Explaining the different types of policies, including hybrid options, to an older client. Answer: B. Offering a replacement policy without disclosing potential loss of benefits or increased costs. Explanation: In Arizona, agents are required to disclose all relevant information when offering a replacement policy, including any potential loss of benefits or increased costs. Failing to do so is considered an unethical sales practice. Agents must also ensure the replacement is in the best interest of the client, recommending inflation protection, option A, and explaining policy options, option D, are appropriate ethical practices. Adding a waiver of premium rider, option C, can be a sound strategy depending on the client's needs. Question 11. Inflation protection. What is the primary benefit of adding an inflation protection rider to a long-term care insurance policy in Arizona? A. It guarantees that premium payments will not increase over time. B. It adjusts the benefit amount to keep pace with rising costs of care. C. It extends the policy term beyond the original length. D. It eliminates the need for underwriting when renewing the policy. Answer: B. It adjusts the benefit amount to keep pace with rising costs of care. Explanation: The inflation protection rider is a crucial feature in long-term care insurance because it increases the policy's benefit to keep pace with rising healthcare costs over time. As the cost of care typically increases, this rider ensures that the benefit amount will remain adequate. The rider does not affect premiums, option A, policy term, option C, or underwriting, option D. Question 12. Asset protection under Medicaid. How does the Arizona Long-Term Care Partnership Program provide asset protection for policyholders? A. It exempts all assets from Medicaid's spend-down requirement once a long-term care insurance policy is purchased. B. It allows policyholders to keep an amount of assets equal to the benefits paid by their long-term care insurance when applying for Medicaid. C. It ensures that premiums for long-term care insurance remain stable throughout the policyholder's lifetime. D. It allows policyholders to transfer assets to family members without incurring a Medicaid penalty. Answer: B. It allows policyholders to keep an amount of assets equal to the benefits paid by their long-term care insurance when applying for Medicaid. Explanation: The Arizona Long-Term Care Partnership Program provides dollar-for-dollar asset protection, meaning that for every dollar of long-term care insurance benefits paid out, a policyholder can protect an equal amount of their assets when applying for Medicaid. This feature helps policyholders avoid depleting their life savings to qualify for Medicaid coverage. Option A is incorrect because not all assets are exempt, and C and D do not reflect the primary asset protection benefits. Question 13. benefit triggers. Which of the following is a common benefit trigger used to activate long-term care insurance benefits? A. Inability to perform two or more activities of daily living, adults. B. The insured reaching the age of 65. C. A doctor's recommendation for preventive care. D. A decrease in the policyholder's annual income. Answer: A. Inability to perform two or more activities of daily living, adults. Explanation: a common benefit trigger in long-term care insurance is the insured's inability to perform two or more activities of daily living, adults, such as bathing, dressing, eating, and mobility. This reflects the individual's need for assistance and qualifies them for benefits reaching a specific age. Option B, preventive care recommendations. Option C, and income changes. Option D are not relevant triggers for long-term care benefits. Question 14. Policy exclusions. Which of the following is typically excluded from coverage under long-term care insurance policy? A. Care provided in a skilled nursing facility. B. Custodial care services at home. C. Treatment for injuries resulting from acts of war. D. Hospice care in a licensed facility. Answer: C. Treatment for injuries resulting from acts of war. Explanation: most long-term care insurance policies exclude coverage for treatment related to acts of war, whether the insured is a civilian or military personnel. Care in skilled nursing facilities, option A, custodial care services, option B, and hospice care, option D, are generally covered as they relate to the insured's ability to perform daily activities or medical needs. Question 15. Non-forfeiture options. What is the primary benefit of a non-forfeiture option in a long-term care insurance policy? A. It allows the insured to convert their policy into a whole life policy. B. It provides reduced benefits if the policy lapses due to non-payment. C. It guarantees premium refunds after 10 years of payments. D. It allows policyholders to reinstate coverage without a medical exam. Answer: B. It provides reduced benefits if the policy lapses due to non-payment. Explanation: the non-forfeiture option ensures that policyholders who stop paying premiums do not lose all their coverage. Instead, they receive a reduced level of benefits based on the premiums they have already paid. This provision is a form of protection against policy lapses and ensures that some benefits remain available even if the insured can no longer pay premiums. Question 16. Elimination period. What does the elimination period in a long-term care insurance policy refer to? A. The period during which the insurer can deny coverage for pre-existing conditions. B. The time between qualifying for benefits and when the policy begins to pay. C. The time during which the insured can cancel the policy for a full refund. D. The period in which the insurer must evaluate claims before paying benefits. Answer: B. The time between qualifying for benefits and when the policy begins to pay. Explanation: the elimination period is the waiting period after a policyholder becomes eligible for benefits but before the insurer begins paying. This period is typically 30, 60, or 90 days depending on the policy. The longer the elimination period, the lower the premiums tend to be. This period is sometimes referred to as a deductible period and is not related to pre-existing conditions, option A, or claim evaluation times, option D. Question 17. Shared care option. In a shared care long-term care insurance policy, how do the benefits work for spouses? A. Both spouses have separate individual benefit pools that cannot be combined. B. Spouses share a combined pool of benefits, allowing one spouse to use the other's unused benefits. C. The surviving spouse receives double the benefits after the death of the other. D. Both spouses must file claims simultaneously to access the benefit pool. Answer: B. Spouses share a combined pool of benefits, allowing one spouse to use the other's unused benefits. Explanation: the shared care option allows spouses to share a combined pool of benefits. If one spouse exhausts their own benefits, they can access the other spouse's remaining benefits. This feature provides flexibility and ensures that if one spouse requires extensive care, they have access to more benefits than they would with individual pools. Option A describes policies without shared care, and C and D do not reflect how the shared care option functions. Question 18. Arizona Partnership Program. Which of the following statements about Arizona's long-term care partnership program is correct? A. It is available to anyone regardless of age or health. B. It guarantees Medicaid eligibility without a spend down of assets. C. It offers dollar-for-dollar asset protection for amounts paid by the policy. D. It requires policyholders to transfer all their assets to the state after policy benefits are exhausted. Answer C. It offers dollar-for-dollar asset protection for amounts paid by the policy. Explanation: Arizona's long-term care partnership program offers dollar-for-dollar asset protection. This means policyholders can protect assets equal to the amount their long-term care insurance policy has paid in benefits. This protects assets from being spent down to qualify for Medicaid. The program does not provide automatic Medicaid eligibility without spend down, option B, or require the transfer of assets to the state, option D. Question 19. Claims process. Which factor is not typically considered when determining whether a long-term care insurance claim will be approved? A. The insured's ability to perform activities of daily living adults. B. The insured's current age. C. The elimination period chosen in the policy. D. The insured's medical diagnosis related to long-term care needs. Answer: B. The insured's current age. Explanation: the insured's age at the time of filing a claim is not typically a factor in determining whether a claim will be approved. The primary considerations include the insured's ability to perform a DLS, option A, the policy's elimination period, option C, and the medical diagnosis, option D, indicating the need for long-term care. Age mainly affects the initial premium costs, not the claims process. Question 20. Tax deductibility. Under what conditions can premiums paid for a long-term care insurance policy be tax deductible in Arizona? A. Premiums are always fully deductible as a medical expense. B. Premiums are deductible if the policy is tax qualified and medical expenses exceed a certain percentage of adjusted gross income. C. Premiums are deductible only if the policyholder is over 65. D. Premiums are only deductible if paid for by an employer. Answer: B. Premiums are deductible if the policy is tax qualified and medical expenses exceed a certain percentage of adjusted gross income. Explanation: in Arizona, premiums paid for a tax qualified long-term care insurance policy may be tax deductible as medical expenses on federal income taxes. However, the taxpayer must itemize deductions and the total medical expenses must exceed a specific percentage of their adjusted gross income, which is currently 7.5% for most taxpayers. This means that while there is potential for deduction, it is contingent upon the policy being tax qualified and meeting the GI threshold. Options A, C, and D do not accurately reflect the conditions for deductibility. Question 21. Policy features. Which of the following features in a long-term care insurance policy can help protect against inflation? A. Guaranteed renewability. B. Elimination period. C. Inflation protection rider. D. Waiver of premium. Answer: C. Inflation protection rider. Explanation: an inflation protection rider adjusts the benefit amount over time to keep pace with rising costs of care, helping ensure that the policy's benefits maintain their purchasing power. This is particularly important given the increasing costs associated with long-term care. Options A and D are standard policy features but do not specifically address inflation. The elimination period, B, is the time that must pass before benefits are paid, which does not relate to inflation. Question 22. Benefit triggers. What is the primary criterion that determines when a long-term care insurance policy will begin to pay benefits? A. Hospital admission. B. Activities of daily living, ABLS. C. Age of the policyholder. D. Policyholder's financial status. Answer: B. Activities of daily living, ABLS. Explanation: benefits under long-term care insurance policies are typically triggered by the inability to perform a specified number of activities of daily living, ABLS, such as bathing, dressing, eating, toileting, and transferring. If a policyholder is unable to perform 2 or more of these ADLs, they may be eligible to receive benefits. Options A, C, and D do not directly relate to the eligibility criteria for benefit payment under most LTCI policies. Question 23. Shared care options. How do shared care options in long-term care insurance policies work? A. They allow spouses to share a single pool of benefits. B. They require both partners to pay premiums to access shared care. C. They automatically reduce benefits if one spouse uses them. D. They eliminate the need for individual policies for couples. Answer: A. They allow spouses to share a single pool of benefits. Explanation: shared care options enable couples to share a combined benefit pool, allowing one spouse to access the other's unused benefits if needed. This arrangement can provide flexibility in managing long-term care needs, especially as care needs can vary significantly between partners. Options B and C misrepresent how shared care works, while option D is incorrect as it doesn't eliminate the need for policies. Rather, it enhances their utility. Question 24. Arizona-specific regulations. Which of the following is a requirement under Arizona state law for long-term care insurance policies? A. All policies must include a lifetime benefit option. B. Policies must offer a free look period of at least 30 days. C. Policies must cover all pre-existing conditions immediately. D. Agents must provide a detailed sales presentation to every client. Answer: B. Policies must offer a free look period of at least 30 days. Explanation: Arizona law requires that long-term care insurance policies provide a free look period of at least 30 days, allowing policyholders to review the policy and return it for a full refund if they are dissatisfied. This consumer protection helps ensure individuals make informed choices. Options A, C, and D do not accurately reflect the state's legal requirements for LTCI. Question 25. Underwriting criteria. What is a common underwriting criterion for long-term care insurance policies? A. Employment status of the applicant. B. Health status and medical history. C. Educational background. D. Marital status of the applicant. Answer: B. Health status and medical history. Explanation: Underwriting criteria for long-term care insurance heavily rely on an applicant's health status and medical history to assess the risk and determine premium rates. Insurers typically review medical records and may require a health questionnaire. Options A, C, and D are not standard criteria for underwriting in LTCI. Question 26. Medicaid and LTCI. How does having a long-term care insurance policy affect Medicaid eligibility in Arizona? A. It disqualifies an individual from Medicaid altogether. B. It allows individuals to protect some assets while qualifying for Medicaid. C. It has no effect on Medicaid eligibility. D. It automatically qualifies individuals for expedited Medicaid coverage. Answer: B. Allows individuals to protect some assets while qualifying for Medicaid. Explanation: A long-term care insurance policy can help individuals protect their assets from being depleted when they apply for Medicaid. Specifically, Arizona has a partnership program that allows policyholders to shield a certain amount of assets from Medicaid spend-down requirements. Options A and D are incorrect. Option C misrepresents the implications of having LTCI on Medicaid eligibility. Question 27. Waiver of premium. What is the purpose of a waiver of premium rider in long-term care insurance? A. It cancels the policy if the insured fails to pay premiums. B. It allows the insured to stop paying premiums while receiving benefits. C. It guarantees premium returns upon death. D. It reduces premiums if the insured is hospitalized. Answer: B. It allows the insured to stop paying premiums while receiving benefits. Explanation: A waiver of premium rider means that if the insured individual becomes eligible for benefits due to a qualifying event, such as needing long-term care, they do not have to pay their premiums during the period they are receiving benefits. This feature helps reduce financial burden during a challenging time. Options A, C, and D misrepresent the function of this rider. Question 20. Alternative funding options. Which of the following is considered an alternative funding option for long-term care? A. Life insurance with long-term care benefits. B. Traditional health insurance. C. Unemployment benefits. D. Disability income insurance. Answer: A. Life insurance with long-term care benefits. Explanation: Life insurance policies with long-term care riders provide benefits that can be used for long-term care expenses while also offering a death benefit. This option allows individuals to combine life insurance and long-term care planning into one product. Options B, C, and D are not primarily designed for funding long-term care. Question 29. Ethical sales practices. What ethical consideration should agents prioritize when recommending long-term care insurance to clients? A. Maximizing their own commission. B. Ensuring the product meets the client's needs and financial situation. C. Selling the most expensive policy available. D. Promoting policies with the lowest premiums only. Answer: B. Ensuring the product meets the client's needs and financial situation. Explanation: Ethical sales practices dictate that agents should prioritize their clients' best interests by recommending products that are suitable for their needs and financial capabilities. This includes considering factors like health, age, and long-term care planning objectives. Options A, C, and D demonstrate a self-serving approach that undermines the ethical standards in insurance sales. Question 30. Consumer education. What is a critical component of consumer education regarding long-term care insurance? A. Understanding how to replace existing policies. B. Recognizing the importance of early planning for long-term care needs. C. Familiarity with the sales tactics of agents. D. Learning about insurance companies' profit margins. Answer: B. Recognizing the importance of early planning for long-term care needs. Explanation: Consumer education emphasizes the importance of early planning for long-term care needs, as this can significantly impact the availability and affordability of insurance options. Understanding potential risks and costs associated with long-term care helps individuals make informed decisions about their coverage. Options A, C, and D do not address the proactive planning necessary for effective long-term care preparation.